Hello and welcome back to the Tech Wealth Chronicles, the podcast where we break down markets, money, and everything in between. I'm Kedhar.
And I'm Vanisha. If you tuned into our last episode of the Tech Wealth Chronicles, you'll remember we spoke to Malay Shah, the principal advisor at Crispidea, when the markets were at peak uncertainty. There were warnings about tariffs, the global economy looked uncertain.
Fast forward to now, a lot has changed. We've seen the official rollout of tariffs. There was a sharp correction followed by a V-shaped recovery. The US economy is looking strong, while India's is holding steady. China slowed down a bit, and Europe is recovering.
So we are back again with Malay, and he's going to help us unpack what's happening now and, more importantly, what investors should look going forward. Before we dive in, just a quick disclaimer: the podcast is meant for informational purposes only and does not contain any investment advice. So, do consult your investment advisor before making any investment decisions. Associates and directors of Crispidea may hold the stocks mentioned in the podcast. These views are based on independent research and analysis. So, Malay, so the last time we spoke, things were pretty uncertain. Since then, markets and policies and global sentiment have all shifted. So, before we get into the details, can you give us a quick overview of what's changed since then globally and in India, and what's changed that investors should know about?
Yeah, I think the last time we all got together was sometime in May, I think around first week of May. And today we are sitting on, I think it's August 6th, Wednesday. RBI just made their announcement just a few minutes back. But a lot has changed in last 3 months, right? So if you were to really see, of course, tariff got all the headlines over the last 3 months. Some good, mostly, some bad. But I think there were a lot of things which have changed, and I think maybe we will first start out with a quick overview on how the different world economies are performing. But as Kedar mentioned, the markets kind of went down, corrected a lot, and then it had a rip on the upside. Basically driving returns more than 30%, especially in the US markets. Trump, of course, negotiated several tariff deals. The big, beautiful bill got passed in the US market. So there's a lot to talk about. But maybe we can start off with a quick overview on the world economy first.
Let's start at the top. We're seeing the US economies grow faster than expected, while China is slowing down and Europe is recovering. What's driving the global divergence?
Yeah, I think last time we spoke, the quarter one US economy GDP numbers had just come out. It had a negative 0.5% year-on-year growth, and overall we were quite pessimistic on how the entire year would turn out. We were projecting less than 1% kind of a year-on-year growth by December for entire 2025. But quarter two actually surprised on the upside. So if you see the quarter two numbers, which have again come out of the US economy, again it had a massive amount of growth, 3% year-on-year growth, which is very large for a $30+ trillion economy. But a lot of that growth is driven by investments largely in AI. So we'll have to see how much of that growth really holds up, because it is capital expenditure driven upside. Also, US is a consumption driven market, right? And consumers have so far held quite well. The job numbers look okay. Employment numbers look okay, but we'll have to see again, how much are they able to hold up going forward as well. There are some early signs of some cracks, but we'll have to see how that holds up. So US actually surprised us on the upside in this particular quarter. Our thesis for the rest of the year still remains fairly, modest to slightly weak. Although we don't foresee a recession happening in the next couple of quarters, but the growth should slow down over the coming few quarters. India, of course, the quarter two results are still awaited. Quarter one numbers were the best in the world. It grew at 7.4%, which was again much above the expectation. China still continues to grow above 5%, although we are expecting China to continue slowing down as well. And of course, tariffs should show up in Chinese, numbers as well at some point in time. But the quarter two numbers were 5.2%, slightly below expectation, but still above 5%, which is great for a very large economy like China. And Europe continues to surprise on the upside. It had a 1.4% year-on-year growth compared to 1.2% which was expected. And I think the entire structure of Europe potentially would change. There is a expectation of larger defense spending that could come around. But yeah, Europe is looking relatively better off relative to the expectation. But overall, our thesis on world slowing down still remains, but maybe not as bad as what we thought would turn out in quarter one.
That's interesting because it's kind of the opposite of what we expected, right? Everyone thought the tariffs would hurt the growth, but that hasn't really happened, at least not now. Okay. So, what's been the actual impact of these tariffs, and why are they not showing up in the economic growth numbers, and how is this going to play out going forward?
No, I think it's a great question. Tariffs were also put on hold for 90 days until July, and that July became August, right? And there were several exemptions which were given for multiple sectors as well during this time. Also, there was one behavior which many of the importers actually in US front-loaded their purchases, and so they built up inventory quite a bit even before the April 2nd tariffs were announced. So if you really think about it, a lot of the tariffs which got paid out or which got pushed out were not passed on to the consumers, especially in the last quarter, right? So we are still expecting some of that to show up gradually in this coming quarters. For example, and some of it is now started showing up. Like, for example, when Apple announced their results, they talked about $800 million impact because of the tariff. If you look at General Motors, they again talked about the impact of the tariffs impacting their purchases and hence their earnings, etc. But it is still not as widespread. Largely, as I mentioned, there was a pre-inventory buildup which was happening. But going forward, potentially, the scenario would change as the tariffs now become applicable, and we now know potentially some of the new rates, and some of this will now slowly start translating into the sticker prices that consumers may end up start paying.
Seeing as how the tariff numbers are now going to start affecting the consumers, what do you think the future growth would be of the tariff effect, and to what extent would it affect? How would they affect GDP growth, fiscal deficit, inflation, and unemployment, especially in the US?
Yeah, so see what the April 2nd was, of course, a shocker. Some of the tariffs were really, really high. Now we know that there are multiple deals which are negotiated with countries ranging from Japan to Vietnam to Indonesia. Also the UK and European region is still under progress. So I think that we have a lot more clarity. The tariff numbers which are being announced are gradually lower than what they were announced on April 2nd. But the fact that they are still there, will definitely show up in multiple areas in which they would impact. So inflation, of course, is likely going to be the first area where we would want to watch out for the impact, and that's why even the Fed is holding on to the rates, because they also want to see the impact of whether some of these price increases or because of tariffs are being passed on to the consumer or not, and hence they are not cutting the interest rates, right? So one, we would potentially see some of these inflation numbers tick higher. As some of the end consumer prices, whether it's on automobiles or whether it is on on the retail shelves, whatever they are paying will start growing higher. The second order effect of some of this potentially could be on the demand slowdown and potentially on the job growth numbers, but the job growth numbers so far are holding quite steady. If you look at the initial jobless claims, if you look at the continuing jobless claims, I think the numbers are fairly decent, although the pace of hiring has slowed down. So number of new hires entering the entire job market is kind of going down, and the companies are slowing down on the hiring side. But overall job market still looks fine, and largely the fiscal deficit is not going to be on account of tariffs. It's largely because of the big beautiful bill, which will make the fiscal deficit situation go worse and worse and worse. And the tariffs are not going to bridge the deficits which are created because of excess spending, right? And we don't have DOGE anymore. I mean, at least in the frame it was started out with. So net, I think, yeah, overall we see tariffs to be inflationary. I think that thesis doesn't change. Fiscal deficit will potentially worsen. Demand situation will potentially go down, and it will have a second order effect potentially also on the jobs and hiring as well. But so far, the US economy is holding up quite well. It's just that it's got now pushed out by 3 months to 6 months.
And while talking about tariffs, let's talk about India. Looks like the chicken has come to roost. India is now facing one of the highest US tariffs, even higher than China in some areas. What's going to happen on the US India trade front? And are we seeing the fallout in terms of sector performance, exports, or pressure in possible bilateral trades?
Yeah, I think, see, India had a very different approach to negotiating a trade deal. Instead of doing like a term sheet, if I were to use that as a terminology, where you are just talking about some headline level numbers, India wanted to negotiate a bilateral trade agreement, and that takes time. I mean, we just signed a bilateral trade agreement with UK, and that has gone for years and years together, right, to come to a agreement on several different aspects of trade. When you see the kind of trade agreement which US has negotiated with Vietnam or with Japan, I mean, those all seem to be like term sheets, including the one with UK, right? So which means that there's still a lot of work that will still need to happen. And some of the trade deals were also fairly one-sided. India potentially didn't want to do like one-sided deal like Vietnam, where Vietnam is being charged 19%, for example, on their exports to US, whereas Vietnam is not charging anything for imports into Vietnam, right? So it is fairly a lopsided deal. So I think India's approach is more fundamental in nature. It wants to negotiate a trade agreement which will hold for years and decades, as opposed to being something very short-termish. So I think that's an approach that we have taken. Now, what it means is India, however, so the long term it is positive, short term it is negative. In the meaning that in the short term it appears that India is behind others, but if you think about the long term, it is ahead of others. Now, of course, there is a Trump's negotiating style as well. So he wants to conclude deals fairly quickly, and as a result of which he has certain pressure tactics, etc., which are coming into play. So, yes, some of the headline numbers that we got recently, that we are going to be tariffed at 25%, which is higher than the Southeast Asian countries, is negative. The fact that there's going to be an additional penalty because of the Russian oil purchase is negative. But I do believe this is more of a short-term issue, and in the long run, potentially it will not have as much of India should possibly be able to negotiate a full-fledged BTA deal, and it will be the first amongst other countries which are negotiating their trade deals with the US.
Okay, so I think India's right now in a tough spot when it comes to trade with the US, especially with tariffs now hitting sectors that actually matter to our economy.
Yeah, I would point out that it is, negative for sure when you compare it relatively to, let's say, Indonesia or Vietnam, or for that matter, even Japan or UK. But if you think about it, India is not an export-dependent country, unlike Vietnam or Korea, or for that matter, China, right? So our share of trade with US also is relatively much lesser compared to some of the other countries. So our overall dependency is much less. There was an estimate done by certain economists that the overall impact of this entire, even if these tariffs were to hold true, will have an impact of not more than 0.2% on the country's GDP, right? And the larger share of India's trade with US is also more on the IT export and digital services, which is of course not part of this entire agreement at all. So I think net, even if it comes to roost, it will not have as large an impact. The impact will be relatively much lesser, except for few sectors like textiles or potentially sectors like pharma, where the impact could be much larger. But at an aggregate level, we expect the impact to not be as much on the overall Indian economy.
The latest earnings seasons show that Indian companies growing profits by just 7% year on year. Even though some results were better than expected, for a market that's supposed to be in high growth mode, that feels underwhelming. So what's dragging us down?
No, I think that's a brilliant question. And I think this is a question that we have been struggling over the last 3 to 4 quarters, right? So India has been in a slow growth lane. We have discussed it in our last podcast as well. And while this earnings season is still playing out, I think there are 100 and 200 odd companies which have announced their results out of, let's say, BSE 500 companies. and the average earnings growth is about 7.1%, which is low. The long range average of India is like 12 to 15%, so 7% is definitely low. But when you compare it with the prior quarter, it is increasing, right? So from 6 odd percent, it has now moved up to 7%. Also, if you see last 3 to 4 quarters, there was an impact because of the election cycle last year when the government actually, stopped spending. And then they had taken their pedal off the capital expenditure, which is now coming back. And if you see the Q1 GDP numbers, they are pretty good, right? So I think and that capital expenditure will continue to happen. Government has also cut taxes on the salaried class, so there's an extra disposable income which will come in the hand of consumers as well, so that should also boost spending. So I think this so net we are growing slowly at this point in time. But the good news is that this capital expenditure cycle is now beginning. The consumption, there's a complete thesis that we want to boost consumption, and it's also happening through rate cuts as well, right? So our rates have come down significantly from February, so that should boost expenditure as well. And last but not the least, I think the good news for India is that its stock prices have been more or less flat over last 1 year. So while earnings have not grown, because the stock prices are flat, the valuations have not gone into a overheated territory. So valuations are starting to look attractive. So I think net, we are in a okay-ish position. We would hope that in coming few quarters, the effect of this expenditures, both on the government side as well as on the consumer side, should show up in companies' results, and this should only increase from here on.
Also, revenue growth is even slower than earnings growth. Are companies just cutting costs to stay profitable, or is it a sign of weaker demand?
Yeah, no, there is definitely this urban consumption slowdown, and it's showing up in the results, right? So the revenue growth is close to about 5 odd percent, which is lower than even the GDP growth. We typically expect the company's revenue growth to be equivalent to the nominal GDP growth, or a multiplier of 1.5, sometimes even up to 2 times of the GDP growth as well. But we also need to realize that Indian economy is not just now driven by listed companies. They are also driven by a very large startup ecosystem. It's also driven by the captives or GICs as we call them. So that of course doesn't show up in some of these numbers. So the urban slowdown is definitely showing up in the revenue growth. But the good news is that companies are of course being able to grow their earnings faster than the revenue growth because of productivity boost. Potentially AI is helping there as well. So which is good for the economy. I think the profit pool as percentage of GDP is growing, and I think that is very positive, and that should do well for the kind of the earning multiples that people would want to pay for investing in India.
Okay, so you just mentioned a slowdown in urban spending and government investments. So do you think that's just a short-term dip, or there's something more structural that we need to worry about later on?
Yeah. No, I think government capital expenditure was definitely cyclical. We expect that to come back again. So that is definitely not an issue. On the personal consumption, yes, there is a change in the behavior, especially within the urban India, not to spend as much. And that's where the government is taking steps, right? Through, the repo rate cuts, as well as through, giving tax concessions, etc. as well. So that should hopefully come back. If it doesn't come back, then government will have to do even more. They will have to be even more aggressive in terms of providing incentives or stimulus there. But we hope that it should come back in the coming few quarters.
So also in this quarter, we have seen some standout performers. And companies and banks, some companies and banks did fairly well. So what's driving this kind of outperformance? Could you explain this?
Yeah, so there's definitely a dispersion in the performance. And at median level, while the earnings growth has been only 7%, there are some pockets which are doing really, really well. Energy is been doing well. Industrials is doing well. Materials, right? There is, of course, this entire talk of this rare earth metals and mining, for example, that's getting a lot of attention. So that segment is doing well. Even the banking and financial sector seems to be holding up quite well. So I think there are multiple sectors which are doing well. Of course, there are sectors which are not doing well, like utilities and staples still continues to be a challenge. Real estate in this quarter was also a challenge. So yes, there's a dispersion in terms of earnings growth. But we are seeing some standout performance, especially in the larger companies. If you see, Reliance numbers were pretty good. L&T numbers were again surprised on the upside and on the positive side. JSW Steel did quite well. So some of these large companies have been doing well. There is of course stress in terms of the tech sector, where AI is having an impact in terms of taking away certain manual, repetitive, low-end jobs. So the pace of hiring is coming down. The large deals are harder. So tech is definitely under stress. And then there are a few other sectors that I talked about under stress as well. But there are some good bottoms up picking that one can always do in a market like this, where they will be rewarded quite well depending on how those companies perform.
We've also noticed that energy, industrials, and materials are the top performers. Is this a sign that traditional sectors are coming back as in the performance in India?
No, I think that's a good question. So I think if you think about industrials, right? India, of course, from a policy standpoint, is trying to incentivize and create more manufacturing jobs. Manufacturing as a percentage of GDP is still very low in India. I think it's probably less than 15%. And I think we really need that sector to go up. If you want to play in the whole China plus one equation, and government is giving a lot of PLI incentives, etc. as well. And the industrials, both from a domestic consumption and exports perspective, is also doing quite well. So I think that as a sector is definitely, will continue to do well over the next decade or so. And I think, energy, of course, at this point in time, if you think about energy, especially the oil part of the energy market is fairly well supplied. So people who are more on adding value on top of energy, like refining, for example, they will continue to do well. Exploration will do slightly poorer. And the natural gas segment and LNG is again doing very well. And of course, the whole renewable energy space is doing quite well as well. So energy, of course, and India is an energy intensive, country from a consumption standpoint as well. So energy sector, of course, is doing quite well. And materials, as I had mentioned earlier, because of certain commodities cycle associated with certain minerals, certain precious metals, there are some companies which have done well in that particular space as well.
Okay, so what about the underperformers? Sectors like real estate, consumer staples, and utilities seem to struggle this time. So what's holding them back?
Yeah, so staples, I think, is a sector which is underperforming globally. No, it's not just an Indian phenomenon. And staples, if you think about it, is of course there are two wheels of the cog. One is the rural spending and the urban spending. Rural market, of course, is no longer a very large driver. The markets are fairly saturated. So even the growth in the rural segment, if you look at the earnings commentary of some of the large FMCG players, the growth is fairly modest. And a lot of the growth that they had got post-COVID, right, was on the account of pricing. And now we are into a fairly, I won't say deflationary environment, but the inflation is no longer like stealing the headlines in Indian market, right? So they are not going to get the growth because of price. They will only get the growth because of volumes, and volumes are already saturated. So I think that continues to be a challenge with them. Real estate, we are still positive that they should come back. It's more cyclicality which is happening in real estate. But real estate also, if you see it's getting into a zone where the affordability becomes a challenge. The real estate prices have gone up very, very sharply. So again, you will see some challenges associated with either on the execution side or on the new sales booking side, especially when the affordability equation comes into play. But we are still very positive on real estate, and possibly in the next quarter or next few quarters, we will not see them in the bottom performers, but we'll potentially see them in the top performing sectors in India.
So overall, would you say that the Indian earnings this quarter is painting a mixed picture, or is there a clear theme which is emerging?
No, I think I would say that the earnings are better than expected. There is, of course, some positive surprise. They are better than last quarter. They are not there where the long-term potential of the Indian market is. So, of course, they need to improve. But we are seeing that there are all the right drivers in place, and hopefully when we sit again in, let's say, when we have this conversation sitting in month of November, we should have seen a better quarter, performance from an earnings perspective coming out, in Q3. between July and September.
Now, coming back to the US, the earnings grew by 8.9%. The tech companies continue to lead the way. Some names like Amazon saw their stock fall despite the strong numbers. What's happening here?
No, so US, when we spoke last, right, had also an amazing earning season. Their earnings had grown by 16% last quarter. This quarter, again, AI and seems to be the big theme, and you will see that disproportionate performance coming in from larger players, whether it's Meta or Microsoft. I mean, they continue to do well. So this number, if you see, so I think there are 335 companies who have reported, and 8.9% is the median growth. So this is lower than last quarter, but of course, it is still, the earnings is still holding up quite well. And some of the larger companies' earnings are even better than expected, right? So I think as long as the AI theme continues to play out, I think US at an aggregate level will continue to do well. Large companies will continue to do well. So I think that is definitely playing out. The positive surprise this time, however, was the revenue growth, because last time we saw that there was very less revenue growth, and most of the numbers were coming in because of the margin squeeze, or rather because of margin expansion. But this time around, even the revenue growth is fairly good, so which is positive overall. So I think this quarter, again, the earnings, as I mentioned, the GDP growth has been good. The earning season continues to be good. Again, there are pockets of companies which does well and doesn't do well. Like you talked about Amazon in particular. So of course, investors have different expectation. They want to see growth on the AWS side of things, which they potentially didn't get. And then there are certain warning signs, from a inflation standpoint because of tariffs coming out on the retail segment of Amazon, right? So it's a mixed bag. But if you see Meta's numbers, if you see Microsoft numbers, for that matter, even Apple's numbers were not bad. I mean, they were positively taken up by the market.
Okay, so when it comes to tech, do you think this rally is backed by real earnings growth, or it is just mostly riding on the AI wave?
No, it is. I mean, currently it's all solid earnings growth. Of course, some of these companies are spending huge amounts on AI. I think the cumulative spend was like close to $300 billion, and that spend is not slowing down; it's just increasing. So companies are definitely spending a lot. If you see even Meta's numbers, they are spending close to $30 billion, and their capex is like practically doubling from last year. So that spend, of course, is feeding into the revenue for other companies like Nvidia or Broadcom and some of the other beneficiaries of that spending boom. So that spend is currently continuing. At some point in time, of course, that spend will moderate. But yeah, currently, of course, all companies are investing a lot, but at the same time, they are also reaping huge benefits on their P&L, where they are getting great earnings, great margins. And of course, good cash flows as well at this point in time.
You also mentioned that sectors like healthcare and energy didn't perform well, which is surprising given the inflation environment. Why are they lagging behind?
Yeah, maybe if you can go to the next slide. I think we do talk about the sectors which are not doing well. So healthcare, if you see, the earnings growth has been negative 5.5%. There are some very large companies like United Healthcare, UNH, which had its own issues with the CEO's death, etc. But also there is a policy environment as well, and there is also a play where consumers have been spending a lot of money, but they are not, basically their claims are still getting rejected. So overall, healthcare in US is driven by a little bit by the policy environment, and that policy environment at this point in time doesn't look as favorable. You see, Trump has threatened to put tariffs on pharma companies, scaling up and going up to 250%. I mean, which will, again slow down the whole R&D spend. So overall, policy environment on healthcare is not favorable, which is potentially showing up in the numbers. But yeah, the technology and financials continue to do well. Financials also had a very good quarter in terms of numbers coming in from variety of companies. Whether you look at Bank of America, Wells Fargo, American Express, all of them had really good numbers to show.
We've looked at earnings seasons in India and in US. What would be one contrast which is seen in both India and US that is contradicting to each other?
Yeah, no. In fact, it seems very counter-cyclical. I mean, India was always highly correlated with US as a market, but now we are seeing a lot of counter-cyclicality. So one example I will give is like tech sector in India seems to be of course, service driven, whereas US is more product driven, and service sectors at this point in time seems to be affected by AI, whereas the product sector is booming because of AI in the US, right? So it's again counter cyclical. If you think about energy is very well supplied at this point in time in the US, and hence it's underperforming, whereas energy is really doing well in India. It's upcoming. Same with basic materials. Basic materials is doing well in India, but not in the US. But there are a couple of sectors which are I would say pro-cyclical, like financials in both the countries is doing well. The other sector is industrials, because both the countries are focused on creating manufacturing jobs, and industrials in both the countries seem to be doing extremely well. So that's again pro-cyclical. And consumer discretionary, while is good in India, at this point in time, it is not doing as great in the US. But hopefully, if the consumer stays strong, maybe even that consumer discretionary sector should come up. So there are some contrasts at this point in time in terms of what's working in India versus what's working in the US. But I think the two common themes, like banking and industrial, seem to be doing well in both the countries. And then there is some counter cyclicality associated with other sectors between these two countries.
We've covered a lot of ground till now, talking about the macros and the micros. But let's keep it real. How should the investors take action based on the insights we've covered till now? What would be the insights into commodities coming up?
Yeah. So I think if you have to convert some of this into what it means for investors, and I think you are asking a question on commodities. Within commodities, of course, we always ask investors to build their position in precious metals. I mean, gold was the de facto precious metals that we always advise to our clients as an inflation hedge, as a currency hedge as well. But we have, of course, diversified from gold and also added silver into the client's portfolio. And we are actually even more bullish on silver at this point in time than gold because of multiple industrial use cases associated with silver. And we are bullish on gold and silver, maybe if not from a very short-term perspective, but from a 3-year, 5-year plus horizon, because it will provide that currency hedge that most Indian investors need. And so we are advising clients to at least build position of anywhere from 10% up to 15% of their total net worth into gold and silver. And so we continue to not time the market for those particular precious metals or commodities, but we ask investors to keep adding their positions onto their portfolio in both those gold and silver as commodities.
Coming to valuations, we can see that large caps are currently performing pretty well. But let's talk about mid and small cap. They are still trading at 33 to 30 times the PE even after the correction. That's historically above average. What is the time for is it time for investors to book profits and shift to large caps?
No, I think it's a great question. See, we have not seen any geopolitical shock in the market at this point in time, with an incident bearing India Pakistan sometime in May. But nothing, the markets have been very resilient so far, and we hope that resiliency continues. But we did this analysis and we published our research as well some time back, where we broke the entire market valuations by different deciles, and we found that there was a lot of overheated territory, especially in the mid-cap space. Large caps, of course, are fairly valued at this point in time, and small caps, while they corrected a lot, since they didn't go up as much, there's a decent valuation to be found in small caps as well at this point in time. Although we are advising our clients to build larger position in large caps, we feel very comfortable in taking larger position in large caps, and we expect them to outperform the small caps and the mid caps. At the same time, they can take 10% of their total equity positions in small caps as well. But yes, the valuations in mid caps are definitely a cause of concern, and people should look at their own portfolio and then try and rebalance their positions in the mid cap space.
Okay, so Malay, you talk to a lot of busy professionals who do not have time to track the markets. And so do you have some advice for someone who is getting overwhelmed with the markets? And what if they want to invest in the US markets?
I think the number one principle that most investors should follow is having a disciplined approach to investment, which is don't time the market, right? But they should continue to keep their asset allocation in mind. We did talk about 10 to 15% investment in commodities like gold and silver. They should, of course, as I mentioned, India markets we are positive, and within India markets we are positive on large caps. Within large caps again we are positive in defense and some of the other sectors like banking, financials, industrials, etc. Right. So I think that can continue. And again, if they are really busy, they don't want to do bottoms up stock picking. They can either work with a RIA, or they can continue to do their mutual fund investments, in a good scheme with good managers, etc. So I think that's something that they should continue for India investments. We are also of the opinion that Indian markets will continue to do well and outperform the rest of the globe as well in the coming few years. So that's again something they should be overweight on India. And to your question on the US market, US market in general, we are at this point in time a little nervous. However, with an exception of certain themes, like AI is still a theme that will continue to play out, and some larger players like Meta, etc., seem to be performing really well. So they can either take a position through an ETF, or they can do an allocation of between 5 to 10% of the risk money, in the US market, which will give them certain currency hedge as well, which is again very important for Indian investors. So net, I would say, continue to stay disciplined, maintain your asset allocation across all different asset classes, and again, if possible, work with an advisor.
So, are there any seasonal patterns or trends that you're seeing right now, or any changes that you have made in your model portfolio, like shifting focus across commodities or sectors, something like that?
Yeah, so we did publish our research on seasonality, and from a seasonality perspective, again, as I was saying, timing the market is sometimes very, very hard. Like July, for example, tends to be the best month for Indian market if you were to look at the averages over last 10 years. But this July, we didn't perform as well, right? So I think the seasonality is a little hard. But if you were to again look at the research, August, September tends to be very bad months for US markets. So one needs to be aware of that seasonality in August, September playing out in the US. Whereas in India tends to do okay August, September. November tends to be the best month both in India and US. So if you have to look at still timing, you can look at, gradually doing your investment in India, from August through November. And in US, of course, try and avoid August and September in general. I mean, again, this may not hold out year on year, but that's like the broad pattern over last 10 years. From a model portfolio perspective, we do have a model portfolio across both stocks as well as across mutual funds. In mutual funds, one of the changes is we are getting more overweight on large caps. So we have reduced our allocation towards mid caps. And small cap, again, we had halted the entire investments, but now we have again started allocating between 5 to 10% of the total mutual fund investment in small caps as well. So that's one change that we have done. We also have a sectoral allocation towards pharma fund, but pharma, we are again going a little slow right now because of the open tariff issue over there. We want that piece to be settled down, although it's a great value purchase if one wants to make a bet on it in terms of that sector coming out of the whole tariff equation. And I think as far as the direct stocks are concerned, we are broadly positive, as I mentioned, on capital markets, on financials. We are adding more defense as well. Defense, we are very positive. We have taken out few stocks which were in our micro cap category, and we have removed them from our portfolio, largely because they had exposure to MFI, microfinance lending. And microfinance, as you know, is a stressed space right now in lending in India, both for smaller companies and larger banks, of course. So we have taken some of those names out, and we have added one name which, of course, we can't disclose the name, but it's a name in rare earth metal space. We are again very positive that the rare earth will continue to play out, and India wants to also striving for its own independence in the rare earth space. So we have added that name, and which we are hoping will play out well over the next 2 to 3 years as well. So that's mota change, in terms of our model portfolio.
And finally, if you had to look ahead to Q3, and at the end of which we'll probably have this conversation again, what do you think the main theme of the said conversation would be? Yeah,
I'm seriously hoping that, let's say, when we get back again in Q3 sometime in November, we won't have to talk about tariff. Hopefully, the tariff will not be grabbing as much headlines by then. And largely, I believe it's possible because a lot of deals are getting done, or even, Trump administration also wants to move on to other areas like deregulation and so on, and other important areas as well. So I'm assuming tariff will not be the theme. I can tell you that at that point in time, potentially we will be now talking about, however, impact of tariff flowing into the inflation and job market. So when we come again in November, from a macroeconomic standpoint, we would possibly be talking about the inflation scenario as well as the job market scenario. So maybe that would be another theme that we would be talking about. And I'm hoping the Q3 number of India looks much better. So hopefully, when we meet in November timeframe, we would have seen improved performance in terms of the year-on-year earnings growth from 7% right now, improving in Q3 as well. So those are the top three things I would say I would look forward to when we discuss again, the Q3 earnings season review.
So we covered a broad range of topics from earnings season of US and India, micro and micro trends, and what it all means for the investors looking forward for asset allocation. So this brings us to the end of our episode of the Tech Wealth Chronicles, and special thanks to Malay for breaking it all down for us.
Thank you.
And also special thanks to the research team, the marketing department, and some our production team. If this episode of the podcast helped make markets a little clearer, do follow us on LinkedIn, Instagram, YouTube, and Spotify. The link for the presentation will be available in the description of the episode.
Until next time, stay invested, stay curious, and keep building your wealth. Thank you.